Core investment strategy is defined by the ability to produce consistent, stable returns with a very low risk to the capital that's invested in the strategy. The reason why core investing exists primarily is to help pension funds, insurance companies deliver those stable returns that retirees need, or people who have bought annuities and insurance products need to fit into that investment strategy. In the real estate world, core assets are assets that have a very long and stable history of producing consistent returns. They're very easy to forecast, and they're designed to produce at least an 8% annualized return, which is that minimum return that investors are looking to get. A core asset is typically worth more than $100 million, and it's typically in the best location in the city and the best style or class of building that you can find. The reason for that is that the majority of the investment is coming from multi-billion-dollar investors like pension funds who have over $100 billion to invest in real estate. For an asset to be determined as core, it has to have a 3 to 5 year track record of stable income, and it has to be the type of income source like a 15 or a 20-year lease where an investor can see year after year that income is going to be consistent, it probably will grow over time, and it will produce that stable return. And that's done using typically 50% or less debt. What creates the safety and stability in core asset investing is the use of course, lower leverage combined with high quality assets and high quality tenants. On the lower leverage side, what we're looking for is a debt service coverage ratio above 2 to 3 times. And as an example, what that means is if you have a building that makes $1 million a year net income, then the debt service that you have to pay is probably going to be between $300,000 and $500,000 a year in actual debt service payments going out the door. So you know you can cover those debt payments at least 2 to 3 times with the net income that you're making. This is what creates safety and stability, that if the rents go down, the income goes down, if there's a recession, that those debt payments can continue to get made and there is still distributable income net to the investors. The benefit on a risk factor standpoint of core investing is that you're going to have that stable income stream, and it's relatively recession resistant because even if the income stream drops a bit, it can still pay its bills and you're not facing the loss of the asset and hopefully not the loss of your capital. The downside is if you paid the highest price to invest in this piece of real estate and there is a drop in the market, like I said, it might take a long time for you to be able to sell that asset in the future, and whatever income stream you're getting off of it will be the only rate of return that you're looking at. You'll be losing some of that appreciation. So upside, of course, is the stability of the income stream. Downside is the loss of access to the appreciation and the growth and value of the asset if you buy at the wrong time. To wrap up the core strategy, it's a strategy that powers the regular payments that retirees see in their portfolios. It's a strategy that powers the annuity business. It's a strategy that powers a lot of how stable income is produced in investment portfolios across the country. And you might be saying, I love to invest in that. As an individual or as a family office or as an investment advisor, that sounds great. Well, the problem is most of these investments and most of these types of properties are accessible only at the highest levels, only with the largest checks, and only through a layer of fees that are between you and the property. So what's a better strategy for investors who are writing smaller checks or investors that are coming in direct into the assets? That's when we enter into the Core Plus strategy.